Welcome back to the deep dive. Today, we're looking at a story that it really flips the script on how we usually talk about business.
Right.
Normally, we look at these earnings reports, especially for a global giant, and the headline is always more volume, more customers, just get bigger.
Growth at all costs. That's the mantra.
Exactly. But today, we are looking at UPS. They just dropped their Q4 2025 earnings report this morning, January 27th, 2026. And the story here isn't about getting bigger at all.
No.
It's about a deliberate, I'd say aggressive strategy to get smaller. They are literally shrinking to grow.
It is the definition of a corporate inflection point. And honestly, it's a high-wire act. They are fundamentally changing what they deliver, who they deliver it for, and this is crucial, who is doing the work.
And before we even get to the numbers, which, spoiler alert, beat expectations, we have to address how the call started.
Yeah.
Because usually these calls are so sterile, let's get to the spreadsheet. This one was different.
It was. The CEO, Carol Tomé, she opened the call by addressing the loss of UPS Flight 2976. It was a very somber moment.
It was.
She took the time to honor the crew members who were lost and thank the team at Worldport in Louisville for holding it all together during a crisis.
It really grounds the conversation, doesn't it? I mean, we sit here and we analyze profit margins and efficiency ratios, but at the end of the day, logistics is dangerous work.
It really is.
It's real people flying planes and driving heavy trucks.
Absolutely. It's a reminder of the human cost that underpins this whole global supply chain. And I think acknowledging that right at the top, it sets a specific tone for the rest of the report.
Especially when we start talking about the massive workforce reductions later on.
Right, exactly.
So keeping that reality in mind, let's look at the financial headline. We are in, what? A messy economic environment. Global trade is weird right now. And yet UPS posted Q4 revenue of $24.5 billion.
Which is a beat. The street was expecting about $600 million less than that.
And earnings per share hit $2.38, beating the consensus of $2.20. And their operating margin held at 11.8%.
Yeah.
Now, for people who don't spend their lives staring at balance sheets, why does that margin number matter so much?
So think of it this way. For every single dollar UPS collects from a customer, after paying for everything, the gas, the pilots, the drivers, the sorting facilities, they kept nearly 12 cents.
Okay.
In the logistics world, where fuel prices are all over the place and labor is expensive, keeping 12 cents on the dollar is, it's actually very impressive. It shows discipline.
Discipline, that's the key word. Because the way they achieved that margin wasn't by flooding the network with packages.
No, not at all.
It was by kicking packages out.
Yeah.
And this brings us to the biggest narrative of this entire report, the Amazon accelerated glide down.
Glide down, it sounds so gentle, doesn't it? Like a plane landing.
It sounds peaceful, but when you look at the data, this is a breakup, a massive one.
It really is. Let's just look at the sheer scale of this. In 2025, UPS reduced the volume of Amazon packages in their network by 1 million pieces per day.
1 million every single day. That is a staggering amount of volume to just say no thanks to.
And they aren't done. The plan for 2026 is to cut another 1 million pieces per day.
Wow.
So total U.S. average daily volume was down nearly 11% in Q4, and more than half of that drop was just them showing Amazon the door.
Okay, I have to play devil's advocate here.
Yeah.
Business 101 says, keep your biggest customer happy. Amazon is the whale.
The whale, right.
Why on earth would UPS actively fire the biggest shipper in the world? Isn't that just incredibly dangerous?
It is dangerous if you don't have a plan to replace that revenue, but this comes down to a concept called revenue quality.
Revenue quality.
Yeah, there is such a thing as bad revenue.
Bad revenue. I thought money was money.
Well, not if it costs you more to earn it than it's worth. I mean, think about a typical Amazon package. It's usually a residential delivery, right?
Sure, to my front porch.
So the driver has to go to a specific house in a suburb. It's usually one small item, a tube of toothpaste, a phone charger. It takes up space in the truck. It takes driver time. But the margin on it is just razor thin.
So it's clogging up the system.
It's clogging the system with low-value boxes. UPS realized they were choking on them.
So they are trading volume for value. They'd rather carry 10 expensive boxes than 100 cheap ones.
Precisely. And the math proves it out. Even though their total volume was down, their revenue per piece went up by 8.3%.
8.3%. That's a huge jump.
It's massive, and it validates the entire thesis. If you clear out the cheap stuff, you make more money on what's left.
But there is a catch, and this is the part that I think makes people nervous.
Mm-hmm.
If you are moving 10% fewer packages, you don't need a network designed for 100% capacity. You have empty trucks. You have empty warehouses.
And that is the cost of efficiency. You can't just shrink the revenue side. You have to shrink the cost side to match it. Otherwise, you're just, paying to heat empty buildings.
And they have been absolutely ruthless here.
Oh, yeah.
The report mentions they delivered $3.5 billion in savings through network reconfiguration. That's a corporate euphemism for closing things, right?
It is. In 2025 alone, they closed 93 buildings in the U.S.
93. That's not a trim, that's an amputation. That's almost 2 facilities a week just gone.
And they aren't finished. They've identified another 24 buildings to close in the first half of this year, 2026, and they are currently assessing another 60 to 70 on top of that.
So we're talking about potentially closing nearly 200 facilities in just a 2-year span.
It's a massive footprint reduction.
And obviously, buildings don't run themselves. When you close a building, the jobs go with it. The headcount numbers in this report were sobering.
They were. In terms of operational positions, they reduced the headcount by 48,000 people in 2025.
48,000. That is the size of a small city.
It is. Now, to be fair, that number includes hiring about 15,000 fewer seasonal workers than usual for the holidays, but the core reduction is still massive. And looking ahead to 2026, they plan to cut another 30,000 positions. They even mention a voluntary separation program for drivers is coming.
So this isn't just a temporary belt-tightening. This is a structural change. They are building a smaller company.
A smaller, leaner company. But here's the immediate problem. You just fired nearly 50,000 people. You closed almost 100 buildings.
But you still have, 18 or 19 million packages to move every day?
Exactly. If you don't have the people, the network collapses. Unless the buildings themselves start doing the work.
And this brings us to the network of the future they keep talking about. It
Yeah.
seems like the bridge between shrinking the workforce and maintaining service is just pure automation.
It is. The stat that jumped out at me is that by the end of this year, 2026, 68% of all U.S. volume will go through automated facilities.
That's the majority of their business. And I assume the economics of a robot sorting facility are just better.
Oh, significantly. The report states that the cost per piece in their automated buildings is 28% lower than in a conventional building.
28%.
Yeah, nearly a third cheaper. That is the only way they can maintain that 11.8% margin we talked about while losing all that Amazon volume.
There was also a lot of talk about RFID. They're calling it smart package, smart facility.
Right.
Now I feel like we've been hearing about RFID, those little radio chips, for 20 years.
Right.
Why is this a headline now? Why has it taken so long?
It's the classic cost curve. 20 years ago, putting a radio chip on a cardboard box just cost too much. It wasn't worth it. Now, the cost is negligible. So UPS has gone and installed RFID readers in all U.S. package cars, all the brown trucks.
So what does that actually change? Is it just about better tracking?
It changes the fundamental nature of the job. I mean, before, a driver had to pick up a box, find the barcode, point a laser at it, and scan it. That's a scanning network.
Okay.
Now, the truck is a sensing network. The truck knows what is inside it automatically.
So the driver doesn't have to scan anything.
No. And more importantly, the truck knows if the wrong box is inside. It reduces misloads, putting a package on the wrong truck, which is a huge cost and a customer service nightmare.
That's fascinating. It's like the truck has a conscious awareness of its own inventory.
Exactly. And they've rolled this out to the UPS stores, too. They call it smart fulfillment. They have 5,500 stores processing 1.3 million packages a day, where the RFID tag is applied right at the point of origin.
So the customer gets transparency from the absolute beginning.
From the moment they drop it off.
Okay, so let's zoom out. We've cleared out the cheap Amazon boxes. We've automated the warehouses. We've put sensors on the trucks.
Right.
But we still need to fill those trucks with something.
Mm-hmm.
If we aren't delivering the toothpaste, what are we delivering?
This is the pivot. If you kick out the low-value volume, you have to replace it with high-value volume. And they're betting the farm on 2 areas: SMB, small and medium businesses, and healthcare.
Let's start with the SMBs, because
Yeah.
that seems like a crowded space. Everyone wants the small business owner.
True, but UPS is winning here. SMB penetration hit 31.8% of their total U.S. volume in Q4. That is the highest fourth quarter percentage they have ever had.
Really?
And the engine behind this is their Digital Access Program, or DAP.
I saw a note about DAP in the transcript. The CEO mentioned that when she joined, DAP revenue was barely a blip. Something like, $139 million?
That's right. And in 2025, it hit $4.1 billion.
Just 4. That is explosive growth.
It is, and it's a brilliant strategy. DAP is basically a platform that integrates into Shopify, eBay, Etsy, wherever these small sellers live, and it gives them easy access to UPS shipping rates.
So instead of fighting for the Amazon contract,
They're empowering the millions of merchants who are trying to compete with Amazon.
that volume has to be much stickier, doesn't it? A small business owner isn't going to switch carriers over a nickel the way Amazon might.
Exactly. It's higher margin and it's much more loyal. And then you have the other pillar, healthcare.
Healthcare feels like the holy grail for logistics right now.
Because the stakes are so high, UPS's global healthcare portfolio hit $11.2 billion in revenue.
Wow.
But they aren't just shipping Band-Aids and hospital gowns. They made acquisitions companies like Frigo-Trans and Andlauer Healthcare Group specifically to boost their cold chain capabilities.
Cold chain. That means keeping things frozen, right?
Right. And think about the difference here. If UPS loses a box of paper towels from Amazon, it's annoying. They refund $10. Who cares?
Right.
But if they are shipping a personalized cancer treatment that has to stay at -80 degrees, or a biological sample for a clinical trial, if that thaws out, it's catastrophic.
It's life or death.
Literally. And because the risk is so high, the profit margin is huge. Customers will pay a massive premium for that reliability. That's why they want this business. It aligns perfectly with revenue quality.
So high stakes, high reward. Now, I want to pivot to a partnership that I have to admit, it baffled me when I read it. The United States Postal Service. I always pictured them as the rival, but UPS is handing volume to them.
It's a frenemy situation. They are formalizing a relationship for their economy product, which they call Ground Saver. It relies on a concept called density matching.
Density matching. Can you break that down for us? Maybe give us a visual.
Sure. Think of a UPS truck like a school bus. If the bus has to drive 5 miles down a dirt road just to pick up one kid, that is an incredibly expensive trip.
Right. The fuel, the time.
The fuel, the driver's time, the wear and tear, it costs more than the tuition you're getting from that one kid. It's totally inefficient.
Okay, got it.
But the post office goes to every house, every day, by law. Their bus is already driving down that dirt road. So UPS uses technology to look at a package and say, do we have a truck going to this neighborhood already? If yes, they deliver it. That's density.
And if not?
If it's that lonely kid down the dirt road, they just hand it to the post office for the last mile.
That makes logical sense, but I have to play the skeptic again. Isn't UPS basically training their customers that the post office is good enough? I mean, if the post office is doing the final delivery anyway, why does the shipper need UPS at all? Aren't they cannibalizing themselves?
It's a valid risk. You are, in essence, acting as a middleman. But UPS would argue that they provide the tracking, the pickup, and the network speed until that last mile. And frankly, they lose money on those rural deliveries if they do them themselves.
So it's better to get a piece of the pie than nothing.
They are betting that it's better to share the revenue with the USPS than to take a 100% loss on the delivery costs, cutting off the limb to save the body.
And speaking of cutting things off, we have to talk about the air fleet. There was a massive write-off mentioned regarding their planes.
The MD-11s. Yeah, the big 3-engine jets.
Classic tri-jets.
UPS retired their entire fleet of MD-11s in Q4. They took a $137 million write-off to do it.
That seems incredibly abrupt. Usually, airlines phase these things out over years to protect the balance sheet. Why ground them all at once?
Because keeping them flying was costing too much. They are old, they guzzle fuel, they require a ton of maintenance.
So they're just ripping the Band-Aid off.
Exactly. And they're replacing them with Boeing 767s. They have 18 of those coming over the next 15 months. The 767 is a workhorse, much more fuel efficient. It's another example of shrinking to grow. Take the financial hit now to have a cheaper, cleaner fleet next year.
So we have all these moving parts, layoffs, new planes, Amazon leaving, USPS entering. It's a lot of chaos.
It is.
How does this all shake out for 2026? CEO Carol Tomei used a metaphor that I thought was pretty vivid. She called 2026 a bathtub.
It's great visual. Picture a bathtub. You have the high sides and the low middle. She's telling investors, buckle up. The first half of the year, the front of the tub is going to be the drain.
So revenue and earnings are going to go down.
Correct, because they are cleaning up the mess. They're absorbing the costs of the Amazon exit, paying for the USPS transition, and eating the cost of retiring all those planes. It's going to look ugly on paper for the first 6 months. Then you hit the back of the tub, the second half of 2026. The automated buildings are all online. The low-margin Amazon volume is fully gone. The healthcare growth accelerates, and revenue and earnings start to climb back up.
So it's a game of two halves. But asking Wall Street for patience is a tough sell.
It is. The guidance for the full year reflects that bathtub shape. They expect full-year revenue to be flat, around $89.7 billion, with an operating margin of about 9.6%.
Flat revenue. I mean, in an era where tech companies grow 20% a year, flat just sounds like a failure.
But that's the gamble. They are betting that investors will see past the lack of top-line growth and appreciate the quality of the profit. They are trying to prove that a smaller, more profitable UPS is better than a massive, bloated one.
It really challenges the standard narrative of growth at all costs. And it raises a provocative thought for me and for you listening. We are in an era where bigger is better has been the mantra for Amazon, for tech, for everything. And UPS is betting the house on better, not bigger.
It's the question of the year. Can a legacy giant truly shrink its way to prosperity? Or will the sheer cost of shedding all that infrastructure, the severance, the write-offs, the closed buildings will that just outweigh the efficiency gains?
And beyond that, it makes you wonder about the future of work. If UPS can replace 48,000 humans with RFID chips and conveyor belts and improve their margins, are we looking at the blueprint for the entire service economy? Is the network of the future just a network without us?
That is the uncomfortable question hiding behind the balance sheet. If they pull this off, you can bet every other logistics company is going to follow suit.
A fascinating and slightly terrifying gamble. So next time a brown truck pulls up to your house, take a look at the label. Is it an RFID tag? Is it a ground saver? The strategy we just talked about is literally being placed in your hands. Thanks for listening to The Deep Dive, and we will catch you on the next one.